Welcome to another episode of Money Matters. Today we're talking about the difference between getting advice on your portfolio versus doing it yourself. It's a question of value, which is a combination of performance and price. Here are the 5 main factors that will affect your decision whether or not to go DIY or to hire a professional. The first one is cost. Secondly, performance. Thirdly, your enjoyment. Fourth is the time. And finally, employer restrictions. Not all charging structures are the same, but you can imagine saving anywhere between 0.5% to 1% or perhaps more per annum by not using a wealth manager. You may also save on some upfront fees as well. Performance. For some, they may find that they can do better than a wealth manager. Perhaps they've done things themselves in the past and they've had some success in finding some good returns. Or on the contrary, maybe they have tried to do it themselves, but they've made a few mistakes, they've lost some money along the way, and therefore they opt to hire a wealth manager. Enjoyment. They may find some enjoyment in the process of buying investments. It can be an absolute thrill to buy investments and see the price go up. Employer restrictions. Some firms place restrictions on their staff on what they can and cannot buy in terms of assets. I work with a lot of lawyers here in Hong Kong, and many law firms put restrictions on what their staff can buy. The same goes for investment banks as well. It's very common for people to use wealth managers to get around these restrictions. In fact, the most common method is to use his Type 9 license to set up a discretionary portfolio, and this gets around a lot of the restrictions. Okay, so you're deciding between doing it yourself and hiring a manager. Let's say you go down the route of trying for yourself. Here are the main factors you need to consider when setting up your own portfolio. First and foremost, always set an objective and understand the outcome you're trying to achieve. It's like setting off on a journey. How can you set off on a journey without first knowing your destination? If you know what you want out of the investment, then you can better set the parameters for picking the right investment for you. This goes hand in hand with the second factor, and that's knowing your time horizon. If you have a very short time horizon, it's probably unwise to pick a highly volatile investment. Because what if the portfolio comes down in value by the time you want to disinvest from the market? With a longer time horizon, you may have that flexibility, that freedom to pick a more volatile portfolio in order to achieve higher returns. And number 3, manage your liquidity levels. You simply don't take or sacrifice all of your liquidity to buy into an investment. It's true that you don't want to hold too much cash because cash is a silent deadly killer of wealth. You're going to lose out to inflation. However, you want to keep some liquidity levels so that you're not forced to disinvest from the market, especially when markets are currently on a bit of a downturn. So always manage your liquidity levels, maintain some levels of cash for financial emergencies. Number 4, pick good value, not cheap. I never hear people saying they want to pick the cheapest thing in anything in life. People generally want good value. That's the same with investments. You don't pick cheap, you pick good value. What's good value? That requires research, due diligence, and understanding of the stock or asset that you're buying, and actually working out, is this asset good value? Or is it just cheap, but actually it's a bad buy? So you really have to understand what you're trying to buy. Which goes hand in hand with the next point, which I just mentioned, which is dedicate the time for research and ongoing management. With ongoing management, what I mean is that you can't just build your portfolio and you think, that's it, I'm done. You need to continually manage that because markets change, conditions change, and what was a good buy initially may not be a good buy later on. So you may need to, or you certainly will need to adjust your setup of your portfolio to adjust to market conditions. Yeah. So you need to make a timetable, you need to read regular updates on what's going on in the markets, what's happening in the news. But at the same time, whilst I talk about news, don't just read the headlines, because if you've seen my articles about the disparity between headlines and market performance, you can't just rely on headlines. You have to spend the time to go into the research and understand what's happening with the markets. Buy what you understand and avoid gimmicks. If something's too good to be true, it probably is. If something's packaged up nicely for you and it seems such a wonderful buy, do your own extra research. Don't just take hearsay and just buy into this whole wonderful product. Understand the investment you're buying, not just all the little features of this product. Be patient. Don't trade, but invest. So this comes back to my original point of knowing your time horizon and setting a clear objective and outcome for your investment. If you're simply buying into the markets, you're trying to buy in and just get a bit of a profit and come out again, that's trading and that's not investing. If you have a clear objective of what you want from this investment, you'll stand a much better chance of getting profits rather than trying to time in and out of the markets. And remain steadfast. Markets will sometimes take a bit of a blow. We have this coronavirus right now. There's a global economic slowdown. Markets will be very, very volatile. You simply don't make knee-jerk, or you shouldn't make knee-jerk reactions when markets take a bit of a hit, because given enough time, the markets will recover again. You have to be realistic with your goals and objectives. The number of times I come across people who want to make a quick buck, they want to be that hero investor where they buy into this stock that no one's heard of, it's super, super cheap, it doubles and triples in money, and they take their money out again, and they've made this wonderful profit. Everybody wants to be that guy, but in reality, you have to be more realistic with your goals. Again, comes back to my number one point: set a clear objective and an outcome for your investment. And you have to be honest with yourself. Are you able to do it yourself? Are you able to dedicate the time and the research to building a portfolio for yourself and dedicating the time to managing it? If you can't, it may be better value to hiring someone else. If you've already had a good track record of investing for yourself, absolutely fine. Keep going, keep pushing, get involved in the markets as soon as possible. Don't try to time the markets, and I'm sure you do really, really well. Okay, so you've decided you want to get advice on your portfolio. You're happy to hire a professional to provide a service to you. So let's talk about that. Here are the factors you need to consider. So don't mind me reading off my notes. So point number one is that don't just go for the brand. Actually, really think about the person you're actually hiring. It's not just the company, but the individual manager you pick. The person you rely on to manage your wealth is just as important, if not more important, than the company itself. And, if you think about doctors, dentists, tailors, hairdressers, personal trainers, people like these, it's very much the person you pick and not the company. It's that relationship, it's that trust you have with them. You trust their ability, you trust in the fact that they're a good person, they're an honest person, and they have your welfare in mind. So, if possible, try to get a solid recommendation from a friend. It doesn't give you any guarantees, but it's a good start. And that removes some of the guesswork. Think of it as getting customer reviews on Amazon, getting peer reviews from another customer. It's the same concept. So if you have a good friend, if he or she is already using a wealth manager and they're very, very happy, ask them, hey, who do you use? Do you mind if you introduce me? That's a good start. So it's really important that you understand the wealth manager's role and where he or she actually adds value to you. So here are the main areas where they add value. Number one is that solutions should be bespoke to you. They should be built around your needs. They shouldn't be off the peg. Secondly, expertise and presenting ideas and concepts that you were never aware of. If it's just a case of the person taking orders from you, then there's not much value in that. Really, you might as well go DIY, you might as well do it yourself, because there are many platforms there where you can simply just do it yourself and it's going to save you a lot of money. So it's not just about taking orders, it's about using his or her experience and presenting ideas to you that you were never aware of. Number three, the ongoing management and accountability to deliver performance. You're paying them a fee, typically an upfront fee and an ongoing management fee. If you're paying them an ongoing management fee, expect that kind of service. And I'll come into this a bit later, but ask them what they're receiving in terms of fees, what they're actually receiving themselves, and what you're getting in return. There's nothing wrong with asking that. Adaptability to changing needs, your changing needs. So your circumstances will change. They will need to adapt their advice to match your needs. And I'll come back to that a bit later on. And finally, number five, service, dependability, and peace of mind. And again, I'll go through this one a bit later on. So you should be receiving a bespoke solution for your needs. It should perfectly fit around your circumstances and what your objectives are. It's not the same as using a broker. If it's simply using a broker, you might as well do it yourself, because it's not about getting access to investments. There are many platforms out there where you can gain access to a comprehensive range of investments. You can do it yourself. There's no real value in using a broker these days. So a good wealth manager should build you a solution from the ground up. It takes into account your current circumstances, your investment objectives, which really comes from a breakdown of your life goals, really. If you look at the bigger picture of what it is that you want in life, what it is that makes you happy, these determine your investment objectives, which breaks down into the parameters of your investment. And it should be a consultative process with your wealth manager to talk through what your needs are and then to build you something from the ground up. You can be as hands-on or as hands-off in the process. I have some clients who really don't have much input when it comes to building a solution. They lean on my expertise to build them something, whereas I have other clients who are very hands-on. They are very opinionated on what they like and don't like, and therefore I receive a lot of feedback from them to build something that suits their personal tastes. So an investment solution shouldn't be vague. It should have a very specific outcome. It should come with an intended time horizon, which can be broken, of course, but there should always be an intended time horizon, and should always have a specific outcome of what they want out of this investment. So not all solutions are bespoke. Some are ready-made and pre-packaged. But the difference is really the difference between a bespoke suit and an off-the-peg suit. Yes, for sure, you can get an off-the-peg suit to fit around you, to fit your waistline, suit your taste, and it'll sort of fit you, but there's no replacement for a true bespoke suit. And that's the difference. If you are building something from the ground up, you know it's made specifically for you. Expertise. So this one ties in with the last one a little bit. Like I said, you're not just using him as a broker, you're depending on his experience and his expertise to bring ideas to the fore. It could be about presenting an ETF that you've never heard of before. It could be structuring your portfolio in a way where the assets complement each other. It could be, for example, building a well-diversified portfolio or making your portfolio defensive in times of economic slowdown. It could be for tax or control reasons. So, for example, building a trust structure that allows you to mitigate some of your tax liability, or indeed passing down assets to the right people at the right time. It's very much looking at the bigger picture and pre-planning ahead so that you're well prepared when things happen. So next is ongoing management. The number of times I've seen portfolios where they haven't been managed for many, many years, anywhere from a decade or more, is absolutely staggering. It's one thing to build a portfolio, but it's just as important to provide an active management of that portfolio, because markets won't stay the same and you need to adapt to current times. It's shocking to hear that some clients are told to buy and forget. It's simply a terrible idea. It's like buying a car and not filling it up, or checking the tyre pressures, or checking the oil level. Eventually, disaster is going to occur. So this is something that your wealth manager needs to acknowledge. Build a strong relationship with him or her. Develop that trust. The more he gets to know you, the better he'll be able to manage your financial affairs and make sure it's still relevant to your changing lifestyle. Which nicely leads on to the final part, and that's service. You are paying for typically an ongoing management fee, so you should expect a service. And like I said before, ask him how much you're paying your wealth manager. How much is he getting paid personally? How much is he pocketing? He should be able to give you a very transparent answer, because he's clearly delivering you an ongoing service. If he isn't, then why are you paying ongoing management fees? It should be as transparent as that. So the whole point of service is that you're building a relationship with him or her, and this should give you ultimate peace of mind that you've always got someone in the background managing your financial affairs. This is the point. So service, and this is really what it all comes down to, is that peace of mind, knowing that you have various people by your side managing different parts of your life. You have your family doctor, your dentist, your hairdresser, your personal trainer, and you have your personal wealth manager who's managing the family financial affairs, and that your children's finances are looked after, your finances are looked after. Someone's always in the background making sure that your money is safe. So those are my key points between DIY and hiring a wealth manager. There's no right or wrong answer. It's very much down to personal preferences. If you have any further questions, please put it in the comments below. Please subscribe and let me know, what do you want to see in the next video in Money Matters.